Let us start with shocking numbers. From 1980 to 2000, the world's central banks sold more than 12,000 tons of gold, about one-third of all official reserves. The Bank of England sold 395 tons in 1999 to 2002 at a price of around $275 per ounce. Today, this is $2000 plus. Switzerland got rid of 1,550 tons. Canada sold almost everything, from 1,000 tons down to a miserable 3 tons by 2016. Why did this happen? The official version is the triumph of fiat currencies. After the collapse of the Bretton Woods system in 1971, gold stopped being the anchor of the global monetary system. The dollar became freely floating, backed not by metal, but by faith in the economy of the United States. Central bankers of the new era, Greenspan at the Federal Reserve and Eddie George at the Bank of England, believed that gold was a barbarous relic. Why hold a dead asset that yields no interest when you can hold United States Treasury bonds yielding 5 to 8% per year? The math was simple. If a central bank holds 1,000 tons of gold with a value of $9 billion in the 1990s, that generates zero income. The same $9 billion in treasuries equals $450 to $720 million in annual interest income. For financing the state, this is substantial. But there is a detail that fuels conspiracy theories. In September 1999, 15 European central banks signed the Washington Agreement on Gold. They publicly agreed to coordinate sales and limit them to 400 tons per year for the next 5 years. Why is coordination needed if the sales are purely economic? Critics argue that central banks were afraid of crashing the gold price through chaotic sales, which would reveal manipulation. Supporters say it was simply civilized transparency for market stability. The suppression theory focuses on motive. The conspiratorial version goes as follows. A high gold price is a vote of no confidence in fiat currencies. When gold rises from $300 to $800, it signals to the world that the dollar is weakening and the printing press is running. For the Federal Reserve and the United States Treasury, this is a political catastrophe. If central banks massively sell gold, they increase supply and artificially suppress the price. Gold stays in the $250 to 400 range for 2 decades. Investors lose interest, and money flows into stocks and bonds, which the United States controls. There is an interesting correlation. The largest central bank gold sales coincided with the stock market boom of the 1990s. The S&P 500 rose by 400% during this period. Coincidence or a deliberate diversion of capital away from gold? Frank Veneroso, a trader at Prudential Securities, released a report in 1998 claiming that large banks such as Goldman Sachs and JP Morgan borrowed gold from central banks at 1% per year, sold it on the market, and invested the proceeds at 5 to 6%, risk-free profit. But there was a risk. If the gold price surged, banks would have to buy back gold at higher prices to return it. Veneroso claimed that central banks gave an unofficial guarantee. They would not allow gold to rise and would sell whenever prices threatened to increase. This was the gold put, a hidden insurance policy. He was fired a few months after publishing the report. A coincidence? The most scandalous case involves the Bank of England in 1999. Finance Minister Gordon Brown announced the sale of half of Britain's gold reserves in May 1999. Gold was at a 20-year low, $252 per ounce, the worst possible time to sell. Moreover, the sales were announced in advance, which pushed the price down even further. Any trader knows you do not telegraph large trades. This became known as Brown's bottom. Britain lost billions of pounds in missed gains. The conspiracy theory claims that Brown was saving American and British bullion banks that had shorted too much gold and faced bankruptcy if prices rose. Central bank gold sales relieved their short squeeze. And now pay attention. Since 2010, the world's central banks have become net buyers of gold for the first time in 30 years. In 2022, they purchased a record 1,136 tons. In 2023, another 1,037 tons. These are insane volumes, not seen since the era of the gold standard. Who is buying? China, Russia, India, Turkey, Poland, Singapore, Kazakhstan. The geography speaks for itself. These are countries that want to reduce dependence on the dollar. The People's Bank of China officially increased its reserves from 1,054 tons in 2018 to 2,264 tons in 2024. But few people believe these numbers. China imports through Hong Kong 1,000 to 2,000 tons of gold annually. Where does it go? Analysts suspect that China's real reserves may be 5,000 to 8,000 tons, but that this is hidden in order not to provoke panic in currency markets and not to drive up the price of gold prematurely. China is playing a long game to accumulate the maximum amount of gold quietly and then announce a yuan backed by gold as an alternative to the dollar. Russia increased its gold reserves from 400 tons in 2007 to 2,332 tons by 2022, almost 6 times. After the sanctions of 2014, Crimea, and especially 2022, Ukraine, the logic became clear. Dollars and euros can be frozen by the West at any moment. Gold, physically stored in Moscow, is untouchable. This is not a conspiracy theory. This is a real financial war. The West froze $300 billion of Russia's reserves in 2022. But the gold that is physically in Russian vaults cannot be seized by anyone. The lesson was heard by all non-Western countries. Diversify into gold. Turkey increased its reserves from 116 tons in 2017 to more than 540 tons in 2024. With inflation of 60 to 80%, the lira is losing value catastrophically. Gold is the only asset that preserves purchasing power. The Turkish central bank also accepts gold from commercial banks as collateral. Citizens massively keep gold at home, traditionally more than 3,500 tons in private hands. This shows that in unstable economies, gold returns as real money. The financial crisis of 2008 was a turning point. The Federal Reserve launched quantitative easing. It printed $4 trillion out of thin air. The European Central Bank and the Bank of Japan followed. COVID-19 in 2020. Another more than $10 trillion of global issuance. Central banks of non-Western countries realized that the dollar is no longer as good as gold. It is an asset that is printed uncontrollably. The share of the dollar in global reserves fell from 72% in 2000 to 58% in 2024. Where is the money going? Into gold. If in the 1990s, Western central banks suppressed gold to strengthen the dollar, now they have lost control. The East is buying up gold. The West can no longer sell. United States reserves of 8,133 tons have not been touched since 1971. A suspiciously constant figure, by the way. Some analysts claim that a new Bretton Woods system is coming, but taking gold into account in reserves. BRICS openly discusses a trade currency partially backed by gold. If this happens, countries with large gold reserves will gain a huge advantage. For every physical ounce of gold on COMEX, the main global exchange, there are 100 to 500 ounces of paper gold. Futures, certificates, ETF without full backing. Critics say this is the same price suppression game. Banks print paper gold endlessly, suppressing the price of the physical metal. But if China and other countries massively buy physical gold, a moment will come when the paper market collapses. Attempts to obtain physical delivery will reveal that there is no metal. Then the price could soar to $5,000 to $10,000 per ounce. From 2013 to 2017, Germany returned 674 tons of gold from the Federal Reserve of New York and the Bank of France back to Frankfurt. Officially, for storage at home. Unofficially, distrust. Is our gold really there? Audits of the Federal Reserve's gold vaults have never been public or comprehensive. The last time they were truly checked was in 1953. Conspiracy theorists ask, maybe the gold is no longer there, maybe it was sold or leased long ago. Now let us critically evaluate. Are there real proofs of manipulation, or is this simply a conspiracy theory of frightened gold bugs? Evidence against the conspiracy. Economic logic of sales. From 1980 to 2000, gold really was a bad asset. It fell from $850 in 1980 to $250 in 1999, minus 70%. Treasury bonds yielded 6 to 10% per year. From the point of view of reserve management, selling gold was reasonable. Transparency of the Washington Agreement. If this were a conspiracy, why publicly announce coordination? It would be more logical to act secretly. The agreement can be interpreted as an attempt to avoid chaos and a collapse of prices from uncontrolled sales. The reversal to purchases is explained by geopolitics. After 2008, the world really changed. The crisis of trust in fiat currencies is real. Sanctions against Russia showed the risks of holding reserves in Western assets. Central banks are buying gold for rational reasons, not because they uncovered an old conspiracy. Lack of direct evidence. There are no leaked documents, no recordings of conversations, no witnesses from central banks who would confirm coordination of price suppression. Everything is based on correlations and suspicious coincidences. Evidence in favor of the conspiracy. Manipulations in the gold market are legally proven. In 2020, JP Morgan was fined $920 million for manipulation in the gold and silver markets through spoofing, fake orders. In 2018 and 2019, dozens of traders from these banks admitted guilt. If commercial banks manipulated, why not central banks? The math does not add up. According to data from GFMS and CPM Group, central banks' gold lending amounted to 4,000 to 5,000 tons in the late 1990s. Where did this gold go? Was it returned back? There is no full reporting. Anomalous actions of the Bank of England Selling at the bottom of the market with a preliminary announcement is either incompetence of cosmic scale or intentional suppression of the price. Considering that the Bank of England is one of the most experienced central banks in the world, the second is more likely. Synchrony of actions. Why did dozens of independent central banks sell in the 1990s at the same time and simultaneously begin buying after 2010? Such synchrony is rarely accidental. Either this is a shared understanding of the economic situation or coordination. Statements by insiders. Paul Roberts, former assistant to the United States Secretary of the Treasury under Reagan, publicly stated, "Gold is manipulated through central banks to protect the dollar." Such statements from people inside the system are rare but significant. The middle path. Institutional coordination without an explicit conspiracy. Most likely, the truth is in the middle. Central banks acted not according to a secret plan from an underground bunker, but through informal coordination and a shared understanding of goals. At meetings of the BIS, the Bank for International Settlements in Basel, heads of central banks meet every 2 months. They discuss the stability of the financial system. If someone says, "Gold is rising too fast, this undermines trust in our currencies," the others nod knowingly. The decision to sell gold is formally made by each central bank independently, but within the framework of a general consensus. This is not a conspiracy in the classical sense, but it is also not a free market. It is a managed market in the interests of the fiat system. What is happening now? The Western system is losing control. Eastern central banks are not playing by the old rules. They are accumulating gold aggressively, without coordinating with the Federal Reserve or the European Central Bank. The gold market is gradually moving from west to east. The Shanghai Gold Exchange already trades larger volumes than COMEX on some days. If China launches a gold-backed yuan, this will completely change the game. Practical conclusion for the investor, whether there was a conspiracy or not is not so important. What matters are the facts. Central banks are accumulating gold at record rates. The share of the dollar in reserves is falling at historically fast speed. Geopolitical fragmentation is intensifying. The debt of developed countries is at levels that require monetization, money printing. All of this is fundamentally bullish factors for gold in the long term. If you believe that the fiat system is stable and the dollar will be strong forever, you do not need gold. If there are doubts, 5 to 15% of a portfolio in gold is not paranoia but reasonable insurance. Final question? Perhaps the more interesting question is not, was gold manipulated, but why is this even possible? In a free market, manipulation of the world's largest asset for decades would be impossible. The very fact that we are seriously discussing this shows that gold is not just a commodity, it is a political asset, an arena of struggle for monetary power. And this struggle is continuing right now.